What if I told you the ETF you've been trusting, the one everyone praises for being safe, might actually be the thing slowing you down? I used to believe VOO was the gold standard. I'd put my money in, dollar cost average each month, feel good about being disciplined, and then move on. Until one day, I ran the numbers and realized I had been playing defense with my future while something else had quietly crushed the market behind the scenes. I'm talking about an ETF that's not just outperforming the S&P 500, it's beating it in the good years while losing less in the bad ones. That combination, it's incredibly rare, like unicorn rare. When I saw the data, I felt a mix of excitement and frustration. Excitement at what was possible, and frustration that I hadn't seen it sooner. If I had just known 5 years ago, things could have looked very different today. This video isn't a hype piece. I'm not here to sell you on anything. I'm here to walk you through exactly what this ETF is, how it works, where it fits in a real-world portfolio, and most importantly, what it could mean for your next 10 years. Because if you're anything like me, you're not just trying to get rich quick. You're trying to build something that lasts, and the truth is, this ETF might just be the missing piece in your plan. Let's break it down. Here's when it all clicked for me. A few months ago, I sat down with a fresh cup of coffee and decided to revisit my portfolio. Nothing major, just one of those routine check-ins. You know, the kind where you say, yep, everything looks fine, and move on. But this time was different. I had just read an article about how some ETFs were quietly outperforming the S&P 500, not just in bull markets, but even during downturns. It sounded like marketing spin, so I brushed it off. But curiosity got the best of me, and I started digging. That's when I stumbled onto a fund called SPMO, the Invesco S&P 500 Momentum ETF. At first glance, I assumed it was just another niche product chasing trends, but as I started comparing the numbers, real returns, not projections, I felt this knot in my stomach. If I had put just part of my allocation in SPMO 5 years ago, I'd be tens of thousands of dollars ahead right now. And it wasn't just about the gains. It was about the missed opportunity, the realization that I'd been playing it too safe, that maybe, in trying to avoid risk, I'd been quietly losing ground. That moment forced me to rethink everything I thought I knew about smart investing. It's what led me down the rabbit hole. And to this video you're watching right now. Let me introduce you to something that caught me off guard. So, what is SPMO, right, and why haven't most people heard of it? SPMO stands for the Invesco S&P 500 Momentum ETF, and it does something simple, but incredibly smart. Instead of holding the entire S&P 500 like VOO or SPY, SPMO selects only about 100 stocks from that list. But not just any 100. These are the ones with the strongest upward momentum based on their recent price action and volatility. In plain English, it tracks the top performers within the S&P 500, the companies that are not just stable, but actively winning right now. It's like filtering the all-stars from an already elite league. Here's how it works. Every 6 months, the fund recalculates each S&P 500 stock's momentum score. That score is based on how much a stock has gone up over the last 12 months, excluding the most recent month, and how stable that climb has been. Then it selects the top approximately 100 companies and automatically rebalances the portfolio. No guesswork, no chasing trends, no trying to time the market, just a systematic way of owning what's working while letting go of what's not. And that rebalancing is key, because momentum in the market shifts constantly. What's leading today could be lagging 6 months from now. But with SPMO, you don't have to manually adjust anything. It rotates the winners in and out for you. It's a simple principle, but as you'll see in the next part, the results have been anything but ordinary. Now this part blew me away. Check this out. You ever see a number and just pause? That's what happened when I looked up the performance of SPMO. I wasn't expecting much. Maybe a few extra percentage points over VOO if I was lucky. But then I saw this. Since inception, SPMO has delivered an average annual return of 18.5%. Let that sit for a second. And in the last 5 years alone, SPMO is up around 130%, while VOO, the darling of the S&P 500, is sitting closer to 84%. But it gets crazier. I ran the math. Let's say 5 years ago, you invested $100,000 into SPMO and added just $1,000 every month. Nothing crazy. With its actual historical returns, you'd be looking at a portfolio worth $353,000 today. That's not a dream scenario. That's real. Now, compare that to VOO with the same contributions. You'd still do well, but you'd be behind by tens of thousands. And what about QQQM, the growth-focused ETF everyone loves? Yes, it outperforms in the best of times. But what about when things go south? That's where SPMO starts to shine in a different way. This is where I realized I wasn't just underperforming. I was missing the strategy that actually adapts to market behavior instead of fighting it. Let me show you why this ETF is actually winning. Let's break this down. Most growth ETFs are like rockets. When the market goes up, they soar, but when the market crashes, they fall hard. Just look at QQQM in 2022. It dropped over 32%. Brutal. But SPMO? It's built differently. It doesn't just chase growth. It balances it with something I call higher highs and higher lows. Yes, SPMO often beats the market in bull runs. We've seen that. But what really blew my mind was what happens when things get ugly. Take 2018. The S&P 500, tracked by VOO, dropped minus 4.5%. SPMO just minus 0.9%. And in 2022, one of the worst years in recent memory, VOO was down minus 18%. SPMO only minus 10.4%. Now let's be clear, that's still a loss. But in bear markets, protecting your downside is just as powerful as growing your upside. Most people assume momentum strategies are risky, and yes, they can be volatile in the short term. But the way SPMO selects and rebalances means it avoids long-term sinkholes. It sheds the losers before they drag the portfolio down. It's not about picking the next big thing. It's about consistently holding what's already working and letting go of what's not. That simple shift is the secret behind SPMO's edge. Now hold on. Let's talk about the flip side. Now look, before you click over to your brokerage and go all in on SPMO, we need to talk about something important. Momentum investing isn't magic, and it isn't perfect. Yes, SPMO has delivered impressive returns, but it comes with its own set of risks, and you deserve the full picture. Let's start with volatility. Because SPMO concentrates only on the top approximately 100 momentum stocks in the S&P 500, it can be more sensitive in the short term. There have been weeks, even months, where the S&P 500 only dropped 1% and SPMO dropped 2% or more. That's because SPMO is heavily weighted toward recent winners, and those can change fast. Right now, for example, Nvidia and Meta make up nearly 20% of the fund. That's great when those stocks are running hot, but if they both have a rough quarter, SPMO feels it hard. That's concentration risk. It's not unique to SPMO, but it's something you need to respect. But here's the thing. That same concentration is also why SPMO has outperformed. It doesn't spread itself thin across 500 companies. It leans into strength, and it adapts every 6 months. It doesn't ride losers down to the bottom. So is it more volatile? Yes. But does it fall apart in every downturn? Number. And that's where controlled exposure becomes your best friend. SPMO isn't meant to be your entire portfolio, but as a piece of the puzzle, a calculated strategic piece, it can supercharge your long-term returns without putting your whole portfolio on the line. That's what I've chosen to do. Let me show you how. So, where does this actually fit in your portfolio? You've probably heard of the 3-fund portfolio. It's a classic US stocks like VOO or VTI, international stocks, bonds. It's simple, it's diversified, and for many people, it works. But here's the problem. SPMO doesn't fit neatly into any of those categories. It's not just foundational, it's not just growth, it's not really value either. It's all three depending on how you use it. That's why I call it a unicorn ETF. And unicorns don't belong in boxes. So here's how I personally structure my core portfolio now. It's a 4-fund approach. Foundational, VOO, S&P 500. Value, SCHD, dividend-focused, lower volatility. Growth, QQQM or SCHG. Momentum, SPMO. Each of these plays a role, and together they create balance. Right now, my allocation looks like this. 33.3% SCHD value, 33.3% S&P 500. Then in the growth sleeve, 12% SCHG, 11% QQQM, 10% SPMO. This way, I'm not overexposed, but I'm still benefiting from SPMO's performance. Alternatively, if you prefer simplicity, you could build a true 4-way split. 25% foundational, 25% value, 25% growth, 25% momentum. Either way, it's not about copying my numbers. It's about thinking more intentionally about how momentum fits into your strategy. Because here's the truth. Most portfolios today are either too safe to grow or too aggressive to sleep at night. But when you combine foundational ETFs with momentum, value, and growth, you start creating a setup that adapts, protects, and still grows. That's the power of understanding your tools, not just buying what's popular. Let's talk taxes real quick. This part matters. Here's something most people overlook when choosing ETFs. Taxes can quietly eat your returns. One of the best features of SPMO, aside from the performance, is how tax efficient it is. Unlike high dividend ETFs that pay out income you'll owe taxes on every year, SPMO has a super low dividend yield, around 0.5%. What that means is most of its returns come from growth, not income. And that makes it a perfect fit for a taxable brokerage account, where minimizing yearly taxable events matters. It just sits there compounding quietly without flooding you with taxable dividends. But on the flip side, imagine what happens when you put that kind of growth engine inside a Roth IRA. Now you're talking about compounding returns that grow entirely tax-free. And in a Roth, you don't even have to worry about capital gains or dividends at all. So whether you're building in a brokerage or stacking growth inside a retirement account, SPMO gives you tax advantages on both ends. It's rare to find an ETF that checks both boxes like that. Before we wrap up, I want to leave you with this. Let me leave you with a question I had to ask myself. Am I just hoping the market will carry me to freedom? Or am I building a portfolio that plays offense, with intention, strategy, and long-term vision? Because let's be honest, passive investing is powerful, but it can also become a crutch. It's easy to fall into set it and forget it, and never stop to ask, is this really the best use of my capital right now? For me, discovering SPMO wasn't about chasing returns. It was about realizing that I could be smarter with my foundation, without blowing up my risk tolerance. This isn't a one-size-fits-all solution, but it's a powerful tool that more investors should at least understand. That's why I made this video. So here's what I want you to do next. Keep learning, keep building, and don't settle for average when better is out there and measurable. If you want to go deeper into building your personal 3 or 4 fund portfolio, check out the next video on screen. I break down how I allocate based on age, goals, and risk. And remember, I'm Mark. This is Dividend Hustle, and we're here to keep investing simplified.